Hello, I'm Rachel, editor of Moneywise. I'm here with James Norton from Vanguard. We're going to talk about cash ISAs and stocks and shares ISAs and why stocks and shares ISAs might be a better option for lots of people. James, thanks for talking us through this.
Thanks for having me here today.
So I want to start off with obviously cash ISAs, still the nation's favourite. But why is it that stocks and shares ISAs can be more beneficial for more people than are currently using them?
So it's a really good question. If you look at the ISA data in the last tax year, roughly 11 million ISAs were taken out and 70% of those were in cash. Cash is a great starting point for everyone. Everyone really should hold some cash. You need it for daily expenses, but more importantly, you need to hold some for emergencies. If the boiler goes wrong, you need to help someone out. At Vanguard, we think generally 3 to 4 months expenditure is a good amount to hold in cash, but that depends. It's very personal and depends on your circumstances. The problem with cash is you look at the return you're getting now, and if you shop around you could get maybe 1.5%. The trouble is that's not going to help you reach your long-term investing goals. It's not going to help you retire in comfort. If you compare it to what you could get in equities, over the last 10 years, equities have done amazingly well. They've returned 8, 9, 10% a year. We don't think that's particularly realistic going forwards. We think a return of more like 5% over the next 10, 15 years is more realistic. But the fact is, if you compound out, i.e. you get a return of 5% year after year after year, compared to 1 or 1.5% on cash, that will make a huge difference to your wealth.
Okay, what are we talking? What kind of disparity is that? What tangible difference do you think that might make to people's life goals?
Huge. So if you take an investment and you get a 5% return each year, you will double your return, your money, after roughly 13, 14 years. If you're getting a return on cash of 1.5%, which is probably quite generous at the moment, I know I'm not getting that, you will double your money after 46 or 47 years. So the difference is huge.
Massive. And then we have to talk about inflation as well, because if inflation is sort of averages, we say about 2% a year, if you're getting 1.5% for your cash savings, while we talk about a return that you get from them, actually the value of your money is gradually being eroded.
Yeah, and that's a really good point, and that comes down to risk. So a lot of people say they prefer investing in cash. I think saving in cash is a better description because it's risk-free, and it's not risk-free. You know, as you said, inflation is eating away, it's nibbling away at your money each year. So inflation is currently at 1.8%, depending on the measurement you take. If you're getting 1 or 1.5% on cash, that's getting nibbled at each year. You don't see it, and 1 year and from 1 year to the next, you don't really feel it. But over 5, 10, 15 years, it has a real impact. What people worry about with investing is that they're going to lose all their money. And you know, if you invest in a palm tree plantation in some foreign country that's not regulated, you might do, but that's not really what investing is about. Investing in stocks and shares should be about buying a portfolio that's sensible for your level of risk, sticking with it for the long term and accepting that it goes up and down over the long run. You know, we talked about a 5% return being reasonable over the next 10 to 15 years. It's not going to make 5% this year, 5% the year after, and 5% the year after that. May do 6% next year, down to the year after, then up 15%. Goes up and down, it's volatile. But as long as you enter with the knowledge and expectation that that's likely to happen, when it does go down, just sit there, do nothing, and don't worry.
So you need a lot more of a kind of iron stomach to be able to switch over to stocks and shares ISAs from cash. And the other thing I think that can be unnerving, certainly when you start off, is when you look at your balance in a cash ISA account, you know to the penny what you have, and you know when you look next month what you will have to the penny. And when you have a stocks and shares ISA, as you say, what you have one day may not be the same that you have the next, and you really don't have a notion of whether this year will be, as you say, a 2% year, a 6%, a 15% year. So you have to be able to accept, I suppose, that day to day, month to month, possibly year to year, things aren't going to be quite so predictable. But then over the long term, it kind of balances out. But what kind of time frame are we talking then?
Generally, we say you shouldn't invest in the stock market if you've got a time frame of less than 3 to 5 years, because coming back to your point, the one thing we can guarantee when investing is that from day to day, your investment won't have the same value. And the reason we say 3 to 5 years is because then you can ride out that volatility. You can ride out the falls in the market.
We should go back to ISAs.
Yep.
And why, so if you are going to start thinking about investing in stocks and shares, or investing rather than putting your money into
Yep.
cash, why you should consider using an ISA to do it. What are the main benefits?
So the main benefits of an ISA are very simple. I think the way to think of an ISA is a tax wrapper that just goes around the investments and shelters it. So the first thing is you won't pay any income tax on the dividends that the shares generate. Second thing is you won't pay any capital gains tax on any gains you make. And actually, I think one of the overlooked benefits of an ISA is that it takes away the administrative burden. You don't need to report anything on your tax return, because the ISA is a wrapper that the government wants us to use. I think the other benefit is the flexibility rules that have been introduced to ISAs. So actually we wouldn't advocate taking money out of an ISA, but actually if you need to, you can, and you can put that amount of money back into the ISA in the same tax year. So the flexibility is an additional benefit.
So it's cheaper and it just takes out all the faff, it sounds like, of investing. You don't have to report things, and you can still have a lot more flexibility than there used to be.
Yeah, absolutely.
I want to ask you finally, James, getting started, if anyone thinks this sounds absolutely brilliant, jolly good idea, let's do it.
Yep.
Top tips for just starting to think about it.
Top tips, yes. What you've got to think about first of all is what your goals are. Why are you investing and what do you want to achieve? And you need to think realistically about it. So we've talked about the 5%. If you're investing and you think you can double your money in 2 to 3 years, it's probably not realistic, probably not going to work. So think about what you're investing for, if it's your retirement or for a deposit on a house in 5 or 6 years, or for helping your kids in their education later. The second thing is think about how much risk you want to take, and that will drive the kind of initial investment decision. How much you hold in equities, which are high risk, and how much you hold in fixed income, which is low risk.
Just the difference between the two. So equities, just shares in companies, and
exactly, they're shares in the companies, and the fixed interest or bonds are a loan from a company. So it isn't a bank account, but it works in a similar way in that they pay interest back to you. The next thing is try and find a low-cost provider, because the best predictor of future returns on a fund is the cost of the fund. It's something that's not widely understood, but high-cost funds act as a drag on the performance. If you have a fund that costs 1.5%, the manager of that fund needs to achieve a 1.5% return just to break even. So keep costs low. And the last thing I'd say is, once you've built your portfolio, once you've made the investment, just sit back and don't worry about it. Review it a few times a year. I wouldn't advocate looking at it every day. And when there's a story about the stock markets in the news, which there will be, it will be bad news probably, don't let it put you off your track. Stay with it.
So you can have a sort of sneaky peek if you like, but don't panic and
Don't
act
panic.
on it.
Yeah. In life, we're programmed to take action and fix things, but with investing, meddling is generally the wrong thing to do.
Okay, which makes life even easier as well.
Absolutely.
James, thanks so much for talking us through stocks and shares ISAs.
Thank you very much.